All right, so we'll be talking about financial independence, early retirement. I could buy that today. Like, later, losers. I'm serious. I could buy that today. I'd have to cash out all of my retirement funds. I'd probably have to get some coins from the change or from my couch and stuff, but I could potentially buy that today. But I don't, because I know that it's just a trinket. I'm not really big on fancy things, for one. I know it's just a trinket. It loses value, and the money that I don't spend will be worth so much more over the down the road. So some people might ask, I mean, a teenager might ask, oh, you have all this money, why don't you buy one? And most people here probably won't say the same thing, but this is my phone for the past 2 years. It's an iPhone 4, and it was already obsolete when I bought it. So some of you might be wondering, well, why don't you just buy another one? You know, it's crappy. And I don't, for the same reason that I don't buy a Lamborghini, because I know, because that still works, and for the same reason I have an 8-year-old Corolla, because it still works, it gets me from A to B, and I know that every dollar I save will be worth tens or hundreds of dollars down the road. And every little dime adds up. And I discovered what many rich people already know, that money is a tool. It's not like the general public thinks money is for buying, you know, a bunch of stuff to show off, but rich people know that it's not. Like Warren Buffett and Bill Gates, they're two of the richest people in the world, and they dress like they shop at Goodwill, and that's for a reason. And rich people know that money is about freedom. Like I said, the general public thinks rich is about showing off, and it does bring status, but the real purpose of money is to be free. No matter what some people will tell you, you can't be free without money. You'll have to work, you'll have to buy food, you know. It's tough to make a moral stand for freedom when you're worried about making your next mortgage payment. If you're wealthy, you're free to do whatever you want. Well, not whatever you want, but you're free to do what you enjoy, essentially. And the middle class and the lower class is essentially tied to money. Rich people can afford to stand up and fight oppression. They can afford to buy their way out of unhealthy work environments, bad bosses, and other unpleasant situations. They can enlist the best doctors when they get sick, and when they want to raise money for business, politics, or charity, a few phone calls to their rich friends is all it takes. Money is freedom from worry and freedom from most forms of BS. And being financially independent means you don't have to work if you don't want to, or you can get away from a boss or a job you don't like. It's essentially, being financially free is having screw you money. So you don't have to stick with something because you have to, you know? Yeah. And there's many people out there, and all this stuff is, you know, I just picked it up off the internet. There's a guy called Mr. Money Mustache who retired at 30. He graduated college at 21, and he started off at like 40,000, and then he quickly went up to 100,000. He was a computer programmer, and he retired at 30 after 9 years of saving. And it's really, really not that. Most people think, okay, you have to work until you're 65, but you really don't. I mean, if you start early enough, you can retire at 30 or at 40 or at 50. But the key thing is saving, not spending as much as you earn, saving the difference. There's many people who have 7- or 8-figure portfolios, which is single-digit millions or double-digit millions, and they never made more than $50,000 a year. There's a guy I'll show you later who he made minimum wage his entire life, and when he died last year at 92, he had a net worth of $8 million. And it doesn't matter how much you make, it matters how much you save. You can make $2,000 a month, which is what I'm making right now, or you can make $20,000 a month. But if you don't live beneath your means, you'll never be wealthy. And the most important thing, like many people that I counsel, well, not really counsel, I try to give them advice, but they're not really receptive, is they need to, you can't save what's left over at the end of the month. You have to, the first thing has to go to, like, if you make a budget, and you should probably make a budget, has to go towards saving and investing. And if you're still in debt, that needs to be priority number one. Don't even think about investing until you're out of debt, unless it's a 401k, because your job essentially gives you free money, so that's 100% return. I'm sure we've all experienced this where we try to wait and see, okay, we'll see what happens at the end of the month, and if there's anything left over, we'll put it aside. No, don't do that. I make about just under $24,000 a year, and I'm saving 20% of my income in my Roth IRA. And every month I was, before putting that away, I was like, okay, we'll see what happens at the end. And then I was like, no, you know what? I'm going to make that a priority, set aside 20%, and I donate 10% too, by the way. And set aside 20%, and the money just isn't there, so I can't spend it. So it's taken away from me before I can see it, and so I don't even miss it. So that's a good option for many people to do. So you should have a certain amount that goes into your saving. You'll be very surprised to see how much money you can actually live on, you know, if you have the right mentality. Okay, let's talk about compound interest. So you may, one of the questions, there are two questions that I usually get: how and why. Well, the why we already covered. Why don't I buy the Lamborghini? And how, two things. I had a very high savings rate when I was in the military. The last 4 years I saved about 50% of my income. And also compound interest. The stock market has been doing extremely well. I got out of debt in 2010, paid off my credit cards and my car in March of 2010. And then I just started, this was before I really understood financial principles. I really understood about investing. I didn't worry about picking stocks, and I don't think very few people here should. Just put it in mutual funds or index funds. Have the market take care of it for you, essentially, as opposed to trying to pick the next Apple, which I think is Tesla, actually, for a number of reasons. Home Depot will probably do very good over the next decade as well, because anyway, I'm not trying to get you to buy those things, but check this out. So this person invested $5,000 a year from the age of 25 to 35. So only 11 years, right? $55,000 was the total they invested, and this person waited 10 years to start at 35. And they went all the way to 60, so they invested $130,000. They took 55 versus $130,000, and as you can see, the one who started early and stopped at 35 ended up at 60 with $615,000, and the one who put in so much more money but started a decade later ended up with far less. And the reason for that is compound interest. Now, I use this is just a general stock market return of 8%. And the stock market recently has been doing a lot better, but historically it's been doing it's done about 8.5%, 9%. So we're going to be conservative and go with 8%. And so the first year, 8% of $5,000 is $400. So it's not very much. And most people want to see something happen, so they're looking at their portfolio, they see it, you know, it's creeping upwards. It's not very good. $400, I could, you know, make more money overnight with whatever. But look at that, 10 years down the road, they're already making more in passive income. And passive income means free money, money that is just created for you. You are doing nothing. You sit down, you do nothing. You're making money in your sleep. But look at that timeline. That's 10 years. Imagine where you were 10 years ago. That is a long time. But it just goes to show. And when you hit 60, can anyone guess how much that passive income is in general? Throw out a number.
48 a year.
Yeah, something like that. $45,599. Or yeah. So that is passive income. That's almost 10 times as much as you put in annually. So it's pretty good. And here's another example. If somebody starts at age 20, and again, we're doing $5,000 a year contributed, they wait until age 25 to start investing, that's almost $700,000 difference. And this is, of course, they're going all the way to age, they do $5,000 a year till age 65. But it just goes to show how important starting early is. And I don't want to discourage people who are, later on in their careers. It can still, investing can still work, but I'm just saying if you are young and can, if I can convince you to start putting money away, I'd like to. And so like Ray talked about, investing can be scary, but if you don't invest, your money's losing purchasing power. Everybody here knows what inflation is, right? Or let me see a show of hands of those who don't know what inflation is. Nobody. Okay, cool. So you guys all understand that. So if you put your money under a mattress, you're actually losing purchasing power. And in the stock market, there hasn't been a single 20-year period where money was lost. So if you kept your money in the stock market, there wasn't a single 20-year period, including the Great Depression, where where you ended up with less than what you started with. This is the rate of inflation over the years. The average has been 3%, so I want you to keep that in mind. So something that you buy for $100 today will be, you'll have to pay how much for in a year? Huh? $103. So keep that in mind. And I also, a lot of people, especially during the recession, were harping on gold. Like, gold, buy gold, Obama's ruining the economy, Bush is ruining the economy, we're printing money, buy gold. But gold is not a good investment. It's great for hedging against inflation. So those who like to put money in their garden, like put the money in the ground, put it under a mattress, gold is a great tool because you can essentially buy the same now with an amount of gold as you could 1,000 years ago and as you will be able to 1,000 years from now. It'll be a little more because gold, there's only a finite amount of gold, but I just want to point out that it doesn't make you any money. And here's a good example. So the cost of gas in 1960 was 31 cents, which is the equivalent of about $2.50 today. Today gas costs around $3. Now, pre-1960, or 1947 to 1964 dimes were made out of silver, and the amount of silver in a dime is worth about $1.15 today. So if you had 3 dimes, right, 31 cents, if you had 3 dimes, you could buy a gallon of gas. Those same 3 dimes will get you a gallon of gas today. You guys get where I'm going with this? Okay. So 200 years ago, if you had invested $370, which is you could buy the same amount of goods today with $10,000. So if you had invested $10,000 of today's money 200 years ago in 1815, your return would be, gold would be $20,000. So the value of your gold would have doubled over 200 years. Bonds, which are essentially loans from companies, would have gone up to $8.3 million, which is pretty good, right, over 200 years, just for a $10,000 investment. But of course, none of us really, hopefully, maybe, none of us have a 200-year timeline. But I just want to prove a point. And stocks, if you had invested in stocks 200 years ago, your purchasing power, the money you would have, is almost $10 billion from an initial $10,000 investment. So that just goes to show how awesome stocks are at making money over a long period. But that means you have to leave it in there, that you can't focus on the money you lose. And what I was talking about before, gold is a terrible investment because it's a dead asset. It produces nothing. Stocks are portions of a company. So that company is actively working to make its shareholders money. And if you own stocks, you are one of those shareholders. When you own a share of stock, you own a piece of a business that produces goods and services to consumers. A good business generates a profit, but gold just remains sitting in the vault. It does nothing for you. So in terms of productive growth, gold is a dead asset that will eventually return to its baseline. And by baseline, basically, it might fluctuate in price over the years, but it buys you the same amount of stuff 1,000 years ago as it does today, and as it will 1,000 years from now. It creates nothing, it produces nothing. And if you're still scared to invest, this is what you get if you invest and this is what you get if you don't invest. And it's actually, it goes down. And here's a nifty little mental tool you can use to see how much your money will make you. It's called the rule of 72, and it's not exact, but if you divide the interest rate, so for example, if you have a 10% interest rate, your money will double in roughly 7.2 years. If you have a 4% interest rate, it'll double in roughly 18 years. So before you start investing, once again, I mean, keep these tips in mind. But if you're in debt, you need to get out of debt, like immediately. Put all of the money you can towards it, and because it's essentially like if you're in a boat on a river. Being in debt is like rowing upstream. All the energy you input into it will be, not all of it, but some of the energy you input will be taken away because the water is actively working against you. Whereas when you invest, it's a snowball effect. That water is actually pushing you downstream. It gets you further than what you would have done under your own power. So know what your strengths are. If you like real estate, do real estate. If you like stocks, do stocks. I don't like real estate because I have to actually put effort into it. I have to research. Whereas with stocks, I can be as lazy as I want, and it works for me. That's what I love about stocks, because my goal is I'm a fairly lazy person, so I want to just sit at home. Well, no, I want to be lazy. So that stocks are my way to do that. And by the time I achieve financial independence, my mentality will probably change. But the beauty of it is that you don't have to work if you don't want to. And also keep it simple. Don't buy into hype. You know, the real estate bubble of the mid-2000s is a perfect example. If we go back to the 17th century, there was a tulip bubble in Holland of 1666 and 1667. It was, people were paying the modern equivalent of like $10,000 for a flower seed. You know, it was just insane. So if you invest, Warren Buffett is the most successful investor in the world. He's worth $67 billion today, and he's the third richest person in the world. And he said last year, if you don't invest in things you know, you're just gambling. And you don't need to be an expert to achieve satisfactory returns, but if you aren't, which most of you probably aren't, I don't mean to be mean, but that's the truth, you have to recognize your limitations and follow a course that is certain to work reasonably well. Sure, there's going to be a lot of people who make more money than you, but they are also very likely to lose it all too, because they're in risky things. So when promised quick profits, respond with a quick no. And I've seen a lot of times in the church when people are like, you know, join my pyramid scheme because we can all get rich. And it's bad. So what is the goal? The goal, like I said, is retiring early. You can work if you want to. Yep. And, essentially it allows you, being financially free allows you to do what gives your life meaning. And the goal is to retire with no debts, with a paid off house, and being able to live off your investments indefinitely. And remember when I said that it's not actually as difficult as some people think? Like there's a guy that retired at 30. What was the stock market return, the conservative one that I gave? 8%. What is inflation? 3. On average. It's all averages. Some years inflation will be in the teens, and some years stock market returns will be in the 30%. Yeah. Okay, so that means you have a 5% margin of error. That means your money grows in the stock market at a real rate of 5%, right? 8 minus 3. So if you are able to save up 25 times your current annual expenses, you can retire. This is like the bare minimum. This is like me. I want to sit around and do nothing. If you need $50,000 a year, you save $1.25 million invested in stocks, in real estate, and bonds. For example, the first year you'll take out $50,000. Your investments will have gone up from $1.25 million to $1.35 million, because that's plus 3%. I'm sorry, plus 8%. And you take out the $50,000. That's 1.3 million. Everybody follow me so far? Okay. The next year, inflation will have increased your need from $50,000 to $51,000 and $51,500. Your investments will have gone up from 1.3 million to 1.4 million. Minus the 51,500 is 1,352,500, and so on and so forth. So essentially, if you have 25 times your expenses, your money will essentially last forever. You could live for 1,000,000 years and your money will last forever. That 4% withdrawal rate, 25 times, will keep up with inflation and keep making you money so you'll never run out. Yes, and there's a difference between investing and speculating, and we've pretty much covered it. But the difference between a speculator and an investor is, okay, so this guy who looks really sleazy, and there's a reason for that, he's saying, okay, so there's an envelope of, I don't know, baseball cards that people are saying, okay, baseball cards are the next big thing. Could be real estate, could be gold, could be tulip seeds, tulip bulbs. Baseball cards are the big thing, and so the speculator sees this envelope of baseball cards, and it's going for $1,200 right now. And he doesn't think, okay, how much is it actually worth? You know, like when during the housing bubble, people were paying 10 times their annual income for what essentially amounts to a shelter. That's what a house is. So this guy is saying, okay, the envelope of baseball cards is at $1,200, and since the market is going up, I'll be able to sell it to a bigger fool for $1,500. He has no use for baseball cards. He just knows that it's what's hot right now, and so he's going to sell it to a bigger fool for more money. Whereas that guy says these baseball cards are only worth $1,000. I don't care what the trend is. I'm not going to buy it because it's $200 more worth than what it's worth. So investing is a long-term thing, and speculating is short-term. Come on. Okay, stocks, we've pretty much covered that. The two ways of making money in stocks are dividends and capital gains. Capital gains is essentially when you buy something and then you sell it later for a higher price. That's a capital gain. Dividends are the money, the earnings, the portion of earnings that you get. And stocks are very similar to real estate in that, oh boy. So dividends are like rent. They're the earnings you make, and capital gains is when you sell the house. Smart and patient investors will eventually be able to pull in tens of thousands of dollars in passive income just by putting the money in early, regularly, and yeah. This guy was the one I was talking about. He never really made more than minimum wage his entire life. He died last year at 92, and he had about $8 million in stocks. And what he would do, he started, and look at this, he started in his mid-30s in the 1950s. So it's really, if you think, you know, you're not 20 years old, it's never too late. He always lived below his means, and he spent the last 50-plus years quietly, patiently, and regularly accumulating equity, which is market share of stocks, in some of the most successful businesses in the world. Multiple times he would have seen his portfolio value decline by 50% or more on paper, but he just plugged away no matter what was going on in the environment. So that's the thing about stocks. You may lose money, but it's only on paper until you sell. And by the time he died, it was estimated he was making $20,000 a month in just dividend income. And this is my last slide. Warren Buffett today is worth $67 billion. He's 85 years old. At the age of 80, he was worth $39 billion. At his 50th birthday, he was worth $500 million. So 99% of his net worth came after his 50th birthday. So really compounding it's a snowball effect. A little now just grows and grows and grows and grows, and the earnings, on top of the earnings, on top of the earnings, it just gets bigger and bigger and bigger. And that's it. Thank you.